Question number 7, part A. During the current financial year, XYZ generated a profit of 5 lakh rupees on a sale of 105 lakhs rupees. The variable expenses are 55 lakhs. Compute the following. Okay. So guys, what we have been given? We have been given sale. Sale is what? 105 lakhs. I am writing everything in lakhs, guys. Sale is 105 lakhs. Then we also have been given variable cost, which is 55 lakhs. We know that sale minus variable cost will give us total contribution. It comes out to be 50 lakhs. Okay. Then we also know that contribution minus fixed cost will give us the profit. So what is profit? Profit is given to be 5 lakhs. So because this is 50, this is 5, I can definitely calculate this value, and therefore my fixed cost come out to be 45 lakhs. So this is the data which has been given to us. Let us start solving the question one by one. What are the fixed expenses of the company? So fixed expenses of the company are 45 lakhs as we calculated just now. Second part, what is the break-even sales for the current financial year? So we need break-even data, but in terms of sale and not in terms of units, because data is not given for units in this question. So first we calculate the PV ratio. So PV ratio is what? Contribution over sales. So contribution is how much? Contribution is 50. We have calculated. Sale is 105. So this gives us the PV ratio, but we need break even sales. So break even sales are given by fixed cost divided by PV ratio. So my fixed cost is 45. So 45 over 50 divided by 105, and therefore my break even sales comes out to be 94.5 lakhs. Okay, let's come to part 3 now. Break even sales if variable cost increases by 20%. Okay, so guys, variable cost has increased, so now new variable cost comes out to be, earlier it was 55 variable cost plus 20% more. 20% of 55 is 11. It comes out to be 66. So now let us calculate our new PV ratio. So new PV ratio is contribution, which will be now 105 minus 66 is my contribution divided by my sales. Sales is how much? 105, and this comes out to be 39 over 105. But I have to calculate. I have to calculate my break even sales, and this will come out to fixed cost divided by PV ratio. Fixed cost will remain same, which is 45. So 45 divided by 39 divided by 105, and this comes out to be 121.15 lakhs. Let's go to part 4. It says break even sales required to maintain the profit at present if the selling price has to be reduced by 10%. Okay, so guys, earlier my sales were 105, but if selling price has been reduced by 10%, so my new sale will be 105 into 0.9, because there's a reduction of 10%, and it comes out to be 94.5. Okay, so now calculate my PV ratio once again. PV ratio comes out to be contribution. Contribution is what? 94.5 minus variable cost, which is 55, divided by 94.5, and this PV ratio comes out to be 0.418. But you have to calculate again break even sales. Break even sales, it comes out to be my fixed cost, which is 45, divided by PV ratio 0.418, and this comes out to be 107.65 again lakhs.
Now the question is, how would you analyze the financial position of a company from the point of view of investor, creditor, an employee of the firm, a supplier of the firm? So basically this question is asking about the perspectives of different users of the financial statements. So in a company, if you're talking about financial statements, so what is included in a financial statement? Balance sheet, then we have P&L account, then we have cash flow statement. Along with balance sheet, we also have notes to accounts, as well as auditor's report. So we must check all these documents before going to deal with a particular company, right? So investors, if you are talking about investors and shareholders, then they invest their money in the company, so they must be expecting certain return on that investment. So investors are interested in knowing the profitability and growth, as well as overall financial health of the company. If you are talking about creditors and suppliers, so creditors and suppliers in accounting, we consider it same. So they are into day to day dealing with the company. Okay. So so they will be interested in knowing whether the company is able to discharge its short term liabilities, right? And if you're talking about lenders, so lenders are the entities who lend their money to the company, right? For example, banks, financial institutions, or even debenture holders. So they must be interested in knowing whether the company is able to discharge their long term liabilities. LTL stands for long term liabilities, right? Coming to employees, so employees, because they are the employees of the company, they must be interested in knowing the profitability or whether the company has a growth perspective, and accordingly, also they must be knowing the thing that where the company stands in comparison to its competitors, right? Okay. So, if you are talking about investors and shareholders, so which financial ratios would be beneficial to analyze the position of a company? So, investors and shareholders, I'm writing here, and then lenders and creditors or suppliers, I am writing here, and then employees. Okay. So which ratios they are concerned about, we are discussing that right now. So if I talk about investors and shareholders, they must ascertain profitability ratios. All the profitability ratios must be checked out by them. Then capital structure ratios. This will give them the idea that the funding of the company is from whether equity or from more of debt component is there in the capital structure, right? Then we must be aware of the solvency of the company, so that can be calculated through solvency ratios. And all the turnover or activity or performance ratios should be ascertained by the investors. Okay. And more particularly shareholders, if I am talking about shareholders, so they are, again, of course, they are interested in all the profitability ratios, and also particularly knowing earning per share, dividend per share, or dividend payout ratio also, right? And price earning per share ratio is also relevant to shareholders. Okay. Coming on to lenders, so if I'm talking about lenders perspective, all the coverage ratios. So coverage ratios will again give them the hint whether the company is having the ability to cover its long-term liabilities or not. Then they are interested in knowing long-term solvency ratios, right? Okay. Then turnover ratios are also relevant to them, and of course profitability ratio, because the company if the company is earning profit, then only it would be able to meet out its liabilities. Okay. So if I'm talking about creditors, so creditors are more interested in knowing short term solvency ratios. Okay. Fine. And coming on to employees, again similarly liquidity ratios, long-term solvency ratios, because in case the company is profitable, they would like to be associated with the company for long-term basis, right? And then of course profitability ratios, because the more the company will earn, the more handsomely will they be paid, right? And ROI also, return on investment as well. Okay, fine. And based on this study, we must also be briefly knowing here what actually types of ratios are there. So if you had, because I have used the terms liquidity ratios or long-term solvency ratios, turnover ratios. So we must be having brief idea about what type of ratios are there. So basically liquidity ratio. So four of the headings can be used to divide the types of ratios. Then we have turnover ratios. So these turnover ratios are also known as activity ratio, efficiency ratios. Okay. And last is your profitability ratios. We want to, if we want to know about the liquidity position or short term solvency, so this is also known as short term solvency ratios. So we have our current ratio, then we have quick ratio, then we have our net working capital ratio, then we have cash ratio, right? And if we are talking about leverage ratio, which talks about long-term solvency of the company, they can be divided into two categories. That is, first is capital structure ratio and the coverage ratios. Okay, so under capital structure ratios, we have equity ratio, then we have debt ratio, then debt to equity ratio. DTER stands for debt to equity ratio. Then we have debt to uh, total assets ratio, DTTAR. So these are not the commonly used short forms, right? So debt to total assets ratio. Then we have capital gearing ratio. This is very important. And last but not the least is proprietary ratio. Okay, so coverage ratios, if you are talking about, then one must calculate debt service coverage ratio and interest coverage. So lenders are more interested in knowing whether the company is able to discharge its financial liabilities, okay, in interest. uh, what is the main area of uh, concern for them? That is the interest coverage. Okay, so interest coverage ratio is there. And then we have preference dividend. So this is useful for those people who are investing in the company by way of preference shares. Okay, preference dividend coverage ratio. And then we have fixed charges coverage ratio. Okay, coming on to our turnover ratios. So I am writing out turnover ratios here. So turnover ratios, we have so many turnover ratios. First is our total asset turnover ratio, right? Then we have fixed assets turnover ratio. Then we have current assets turnover ratio. Then we have debtors turnover ratio. And similarly, we have payables turnover ratio. Okay. And the most significant ratio, profitability ratios, how much the company is earning. So they can again be divided based on their relatedness with sales or overall return on investment, and also from the owner's point of view, and from market or valuation purposes, right? So we are talking about sales. Under the ratios which are related to sales, They can be categorized under GP ratio, net profit ratio, right? Operating profit ratio, cost of goods sold ratio, right? And so on. In operating ratio, financial expenses ratio. If you are talking about profitability ratios which are related to overall ROI, so we have categories like return on assets, return on capital employed, and return on equity, right? And from owner's point of view, which ratios are relevant? Earning per share, dividend per share, and then we have dividend payout ratio. If we are talking about from market or valuation purpose, then price earnings per share ratio has to be calculated, or market value or book value per share ratio has to be calculated, or dividend and earning yield. These are the ratios which are useful for different users of the financial statements. Okay, so in this way we can conclude this question.
Next one. Critically evaluate the impact of online marketing on traditional marketing channel. On traditional marketing channel, the impact of online marketing. In view of fierce competition faced by online retailers in emerging post-pandemic situation, evolve a strategy for traditional retailers for survival and growth. So there are two parts to the question. Let's look at part one. What is the impact of online marketing on the traditional marketing channel? So we have to focus on distribution decisions only. So guys, first impact of online marketing is that there is disintermediation. What does this mean? That less number of members in the channel. The number of so there is a channel starting from manufacturer, wholesaler, retailer, and so on. So because of online marketing, this layer has reduced, and the number of members in the entire channel, this number has reduced. Second thing, because of online marketing, there is better access to information among channel members. What does this mean? Now, because there is better access to information, so the prediction of demand and supply is better. There is reduced bullwhip effect. So we have got better information among all members of the channel. Number three, there is better inventory management, because now we have got access to more information. Then what else? Now on the marketing channel, in the marketing channel, through the now because of this online marketing channel, we have got access. We have got access to wider market. And similarly, guys, you can even build up more points like this has reduced cost also. Reduced cost. Okay. Let's come to second part now. That evolve a strategy for traditional retailers. So traditional retailers क्या कर सकते हैं when they are facing competition from the online retailers? Number one, guys, now because of online capabilities, the traditional retailer have access to wider base of suppliers. So now they have got more supplier, better supplier, so they can command better rates from the suppliers. Second thing, of course, access to wider market. By using capability of online, now you can reach out to more customer. Even traditional retailers can reach out to more customer. How they will do it? They have to adopt a hybrid strategy. Hybrid means what? That they are traditional retailers, so they have got offline presence. So what they should be doing? They should be offering a hybrid strategy of offline plus online. So while running business in the offline, they should take care of capability which are offered by online marketing as well. So they should go for the hybrid strategy. Number four, they can use social media for what? For promotion. Number five, what else can they do? They can offer now more customized products and services. Because of online marketing, they have opportunity to get in touch with customers on one-to-one basis, so they can offer customized products and services. Similarly, you can build the, different points around this.